capital goes where it's treated best. And I have to confess to you, for the last umpteen years, like, why would you invest abroad? The U.S. was consistently outperforming everything, okay? And I like to joke with people, since I cut my teeth in foreign stocks, if I can make or lose money between 9:30 a.m. and 4 p.m. Eastern time, why do I have to get up in the middle of the night to watch the Japanese market or get up early to watch Europe? Now the story has changed. And the whole world's overweight dollar assets. So I think the game has changed. I think there's rotation. I think U.S. markets will continue to underperform foreign markets. So there.
George Noble, CIO of Noble Capital Advisors, also someone who has had a storied investment career of 44 years and was also the former research assistant to Peter Lynch, and someone who is prolific on social media, especially on X. You are known for your spaces that you hold. It is such an honor to welcome you to the show for your debut. Thank you so much for taking the time to join me today, George.
Thank you for having me, Julia. I'm as they say, long-time listener, first-time caller. So it's an honor to be here. I don't miss an episode of yours.
Okay, well, since you are someone who watches, you probably know where I'm going and where I always start the show. And we always kick things off with the big picture, that macro view, that framework in which you're looking at the world today as it relates to the markets and the economy. And one thing you might know about this show, George, is you can take all the time you need to set the table. So where are we today and where do you see things headed?
Julia, if you know me well enough, it's dangerous to give me all the time I want because I'm rarely short for words.
It's all good.
So, there's the economy and there are markets, and they're not always the same. And everyone likes to focus on the economy and from there go to discussion of the markets. I think in recent years, the two have become so increasingly disconnected that one doesn't necessarily read across to the other. So let's talk about markets. We can work backwards about the economy. I think we're in a regime shift. The tectonic plates of the world's capital markets and economies are changing. We've had this, much talked about U.S. exceptionalism go on for the better part of, basically since the GFC. I think that is in decline. Not the U.S. is in decline, but the true U.S. exceptionalism, people often think about these great companies, unique companies that we have that have modes, strong cash flow generative, et cetera, et cetera. But there's there's another alternative way in which one could talk about U.S. exceptionalism. And that is the extent to which the U.S. is really the best story in town or the best story in the globe. Largely led not just by our innovation, but also by our tremendous deficit spending that was truly exceptional. And I would say from a couple of perspectives, one, I think at the margin, the impetus for accelerating growth in budget deficits is declining. I think Doge is a complete scam, but we'll leave that for later. But also on the other side of the ledger, if you look at what's going on in China, you look at what's going on in Europe, there are fiscal stories emerging there. So the U.S., the combination of a reduction in the increase of spending, it sounds like something a politician would talk about. I don't think spending is actually going to decline. But the relative growth between the U.S. and the rest of the world is diminishing. So in that respect, I think U.S. exceptionalism is kind of being pushed to the wayside. I don't know that we're in a bear market necessarily. That's a really tough one. I think we're certainly in a global rotation. I think U.S. equities are going to continue to underperform the rest of the world, as has been the case already this year, which stands starkly in contrast to what we've seen for the prior 10 or 15 years. This trend has just started. Things like this, when they start, they don't just end after a couple of weeks or a few months. Broadly speaking, the U.S. market is unchanged, I think, on the year. You look at European markets are up 20%. Latin American markets are up 20-25%. Japan's unchanged. So there's information content in that. And, I think there's a lot more where this came from. Why? Again, I think the relative growth is shifting between what we see here and what we see abroad. And I think also the dollar has certainly turned. Very meaningful decline that we've seen so far. The dollar is still very overvalued. But overvaluation doesn't really tell you very much. It's not like, you wake up one day and people say, oh, XYZ's assets overvalued, so the price should go down. It doesn't work that way. You usually need a catalyst, something to change at the margin for that to occur. But the dollar is still expensive despite its decline. Foreigners, as you know, Julia, they've piled in I don't know, 25, 30 trillion in assets over the last 10, 15 years. That money's starting to go home. We certainly are not treating foreign capital very well with the proclamations that are coming out from the administration. I don't want to make this political, but think about it for a second. If you're a foreign investor and you look at the U.S. and you say, wait a second, these guys are spending money like a drunken sailor. And Julia, please note to self, the U.S. budget deficit is accelerating, is I think spending is up 7% year on year, some number like that. I can't quite remember. But the deficit's getting bigger, not smaller. So forget about Doge. I mean, Doge worked for about 3 weeks. It's kind of like, as Louis Goff says, you go on a diet for 2 or 3 weeks, you don't like it, the heck with that. I'll go back to eating French fries and having Coke, okay? Like, Doge was never a thing. It was a great talking point. So any of that, we're continuing to spend irresponsibly. As I said, we're discouraging foreign investment to come in here. We actually want the money to go back. We want the dollar to go down. So think about it for a second. If you're an emerging market and you've got your public finances are in disarray, your currency's weakening, the IMF, the World Bank might come in and say, hey, you know what? You should tighten your fiscal belt and maybe you should raise interest rates. Well, nothing of the sort's happening here. We're continuing to spend like crazy. And if anything, the White House wants to browbeat the Fed into cutting rates, which I don't think is going to happen. So foreigners are starting to take their money out. And I'll stop with this one. Capital goes where it's treated best. I have to confess to you, for the last umpteen years, like, why would you invest abroad? The U.S. was consistently outperforming everything, okay? And I like to joke with people, since I cut my teeth in foreign stocks, if I can make or lose money between 9:30 a.m. and 4 p.m. Eastern time, why do I have to get up in the middle of the night to watch the Japanese market or get up early to watch Europe? Now the story has changed. And the whole world's overweight dollar assets. So I think the game has changed. I think there's rotation. I think U.S. markets will continue to underperform foreign markets. So there.
Yeah. Great frame up to the conversation. And there are a lot of threads I'd love to pull on with you. So you pointed out that you don't know if we're in a bear market, but you point out that we're in this global rotation. So maybe you said it, but I may have missed it. What regions or markets are you seeing as the beneficiaries of this rotation, especially since so many folks are, as you put it, they're overweight these dollar assets? Where do you think the rotation's headed, and what are you kind of seeing out there?
We can kind of go around the horn a little bit.
Yeah, that'd be great.
But don't press me too hard on that. But so European markets, look, the growth is anemic. Demographics are challenged. There's too much red tape. We know all that. All right. However, a few weeks ago, you saw the release of the debt brake by the Germans and their promise to spend umpteen gazillion dollars on defense going forward. So there is a fiscal story to be seen there, which is going to provide an impetus to growth. I'm not going to say for a second that Europe is a great source of wealth creation or they have more unicorns or innovative countries and companies in the U.S. Certainly it's not the case. But you see how the European equity markets have responded. Also, the European bond markets, the Bund yields have soared with all the other European yields, signaling fiscal impetus. So, and then I also throw into that, and we can get into geopolitical stuff later. But if you want to just spitball for a little bit and think about what could go right, when people say to me, "Well, George, you're too negative, you're too cautious," well, I would finger actually, just imagine if the Ukraine-Russia situation sorts itself out. And if some type of deal is reached whereby the Russians actually provide more energy to Europe. So, and Europe's also coming from a place where it's very underowned. It's crazy, but you see like some London-based funds, pension funds, they got 75% of the money in U.S. equities. So the positioning is just all wrong. So Europe is one place. China, I couldn't believe this when Louis Goff pointed this out to me. China actually outperformed the S&P last year. And so you look at the Chinese market, which is relatively cheap. Accounting standards leave something to be desired, but it's relatively cheap. Tons of liquidity piling in. The dollar's weakening, so the PBOC is free to move about the cabinet, as they might say. They can ease. They are easing. Historically, the Chinese equity market's been a terrible place to invest. They've really been more concerned about their currency and their bond market. Now, though, there's been a definite policy shift from the upper echelons of the Chinese establishment. So I think the Chinese market looks decent. Hong Kong is up, I think, 25% year to date. Latin America also looks pretty good. I think as we move to a more of a tripolar world. We're more regionalized. I think you're going to see more happening in South America. The U.S. is going to turn away from China and move more towards South America as well. And so, I can give you a narrative, but I've learned over the years, try to listen to the message of the market. And the market's telling you already, given the extent to which the U.S. has been lagging, that there is change afoot.
All right. Another area I want to explore with you, as you point out, the deficits, they keep accelerating. I want to explore the implications there, what this means for rates. What do you think the end game is for where we're headed, just from like our, more of our fiscal picture here in the U.S.?
It's a mess. There's two ways that debt will be dealt with. Door number one, we default. That's not happening. Door number two, we devalue the debt. I think as Alan Greenspan famously once said, 25, 30 years ago, they asked him about the ability of the U.S. to continue to pay its Social Security obligations. And he said, yeah, I can assure you we'll continue to pay those obligations, but I cannot assure you what those dollars will be worth that we'll pay you with. All right. So in other words, historically, the way governments deal with this is a soft default. It's a devaluation. And last I checked, there was no constituency running around saying they're in favor of cutting social programs. And keep in mind that, between Medicare, Medicaid, Social Security, defense, I think you're up to interest, you're up to 80, 85% of the budget. There's not a lot to cut. I came out very vocally, actually, post on November 6th. You mentioned my social media presence on X, pointing out that when Musk was yelling, we're going to cut $2 trillion out of the budget, and then it became $1 trillion, and then it's 150. There's just no way that was humanly possible. The whole thing was performative theater, as far as I'm concerned. So, as my friend Michael Kramer coined the phrase a couple of months ago, Trump doesn't hold the cards. Borrowing from the Zelensky-Trump conversation, Trump doesn't hold all the cards. Mr. Market holds all the cards. And in particular, it's Bond, James Bond, or Treasury, that holds all the cards. And so Trump can engage in open, and again, it's not political. My job is as a financial person, all right? He can engage in open mouth operations as much as he wants, but the market's not buying what he's selling. And so, you already see yields up to 4.5%. I think one of the surprises when people ask me, what could really go wrong? And not to predict some black swan out of left field, which no one can figure out. But I think the markets are going to be surprised by the speed and the extent to which bond yields rise. People talk about this Liz Truss moment, and because the numbers just don't add up. And so coming back to the question, I'm reminded of the line, without action, there's crisis. Without crisis, there's no action. Therefore, since there's no action, we will have a crisis. In other words, the market is going to force their hand, because until the market forces their hand, I don't think they're going to do anything about it. Just going to let it rip.
What do you mean by force their hand?
Well, I think if tomorrow bond yields were at 6% and Congress wakes up and it'd be like, now we have a problem. All right. And, Julia, this, you've been around long enough. Oftentimes, the market has an inability to focus on more than one thing at a time. It often just focuses on what's right in front of it.
That's true.
We all know this is going on in the background, but one day will come, it will be a problem. All right. And when you want to know, it's next week, next year, I don't know, but I see yields going a lot higher. You look at where inflation is, it's not in the 2s, it's in the 3s, and it's stuck there. You also look at, the extent to which bond yields have been suppressed by the borrowing at the short end instead of the long end. Smarter guys than I that look at this tell me that really bond yields should be 50 or 75 basis points higher. It's just that Yellen and now Bessent have been borrowing at the short end, not at the long end. And so you got a lot more supply coming to market, and inflation's not coming down. And so, and the foreigners, again, think about this for a second, Julia. If you had a pulse, if you were not clinically brain dead, and someone said to you, hey, you know what? You should, and Julia, you're spending $5 trillion. Your income's $5 trillion. You're spending $7 trillion. You owe $37 trillion. Oh, by the way, there's $100 trillion off balance sheet liabilities. Lend me some money at 10% for 10 years at 4.5%. You want to sign up for that? I don't think so.
No.
I think what's happening is there's a lot of there's a lot of liability mismatching that goes on. People have to buy bonds to satisfy, long-term obligations. It's quite possible or likely when people talk about deregulation, you'll see a relaxation of the SLR. The banks will be compelled, urged, persuaded to buy bonds, and they'll reduce their capital requirements to zero on those bonds. But I don't see, people say, oh, what about the austerity continue? Austerity? There is no austerity. Spending is continuing. Rates aren't particularly high. And if you think they're high, then look at all the craziness that's going on with the wild speculation in the meme stocks. I mean, oh yeah, Bitcoin 109,000, we're restricted. I got it. Okay, so I think the market is what's going to have to put its foot down. Until it does, party on.
Yeah, party on. Let me ask you this, because you were mentioning Trump's going to want to browbeat the Fed into cutting rates. And I look at the betting markets, our friends at Kalshi, and the betting markets, the prediction markets are showing only 2 rate cuts expected in 2025. That's what the prediction markets are showing as of today. But I kind of sense that maybe that might be even too optimistic from your viewpoint. Is that fair?
Okay. I don't want to say the only way. The most likely way that rates are going to go down, you don't want to know.
Oh gosh, tell us.
No, it's going to be because you have a recession. Okay? Like what people want their 2024 back. They want their 2024 back. Okay. They want, easier Fed. They want their low rates. They want their slow growth. They want their disinflation. They want their higher corporate profit margins. They want the higher stock prices. Okay. You could have any one of those things. Problem is you can't have them all at the same time. And for those that want to go back, I'm old enough to remember when, Julie, 2024 or January 25. Remember the optimism that we started the year at. Dorothy, we're not in Kansas anymore. We're not going back there. The world's changed. That's my opinion. So I think that it's a brave new world. I'm losing too many cliches here, but you get the picture.
Wait, what do you think the probability of a recession is? Because again, I'm looking at the prediction markets, 37% chance of recession, which is way off from if you start back at the 1st of May, it was north of 69% was the prediction markets were calling for.
Okay. So I didn't answer your question about the rate cuts.
Yeah.
I was talking about. So it wouldn't surprise me to get 0 rate cuts this year. And the number of rate cuts in the recession are kind of tied together. So for $50 in double jeopardy, okay, let's assume, and we're taping this today on a Thursday, so we got this news yesterday about from this court, there'll be no tariffs, whatever, that's going to be contested, who knows where that's going to go. But if it turns out there are no tariffs, and we still have, and so you're going to say, oh, it's okay now, the foreigners should be not so worried anymore. No. Because you look at the speed with which policy changes here, right? You still have the fiscal expansion in full effect, and with the added impetus of what's going on in the rest of the world now, where they put their foot on the fiscal accelerator. I think it makes more strongly the case for higher bond yields. So it's a seesaw, all right, and I'm less confident about we're going to recession, not going to recession, because there's so much uncertainty, Julia, associated with that. They always say markets are good at discounting risk. It's like, Julia, what's the chance you get in a plane that it crashes or you cross the road and you get hit by a car? Insurance companies have good tables to guess that, right? So you have a normal distribution, a Gaussian probability distribution for that. But when you're talking about uncertainty, where you just don't know, you have no benchmark for that, and it's based upon what Trump is going to do on trade. And by the way, nobody knows what Trump's going to do on trade. Not even Trump knows what he's going to do on trade. It changes every day. But it's become a national parlor game. You have all these experts. Julie, you commented about me in my presence on X. I like to joke with people. Everyone's a trade expert now. Okay, the same guys who were experts in Jevons paradox and AI a few months ago. And before that, they were global epidemiologists. And before that, they're counting container ships in the port of LA, live shots to show you how trade is collapsing. Everyone's got an opinion. And what I'm saying is, to come back on trade, nobody knows. And I just think there's a lot of uncertainty. And markets, again, they can price risk. Pricing uncertainty is something totally different. And so I think you have to be flexible. You got to be humble, realizing we just don't know. We don't know.
Yeah.
So could be recession, might not be. But recession, I think margin, put it one way, get a recession, margins are going to be impacted. The budget deficit is going to blow out. We're running this 7-8% deficit as a percentage of GDP in good economic times. It will get bigger if we have a recession. And if we don't have a recession, I think interest rates will continue to rise because the inflationary pressures are still evident. I mean, and so I just don't, that sort of Goldilocks environment where, give me back my bull market. I don't think so.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. I want to go back to another comment you made around Doge. You're quite critical of Doge. Did you think Doge was going to be a failure from the get-go? Or I don't even know if that's a good question, but I take it Doge was a big disappointment.
To the public, maybe.
Yeah, way more on your thoughts on Doge. I am curious.
To me, no. Because I said before, we can go back. I have a tweet from November 6th. And it was a breakdown showing where all the money goes. And as I said, between the interest and defense and the entitlement programs, you're up to like 80 or 85% of the budget. So you're talking about, let's call it 80%, 85% of 7 trillion. You're talking about 5.5, 6 trillion. And that only leaves a trillion and a half of discretionary spending. As the saying goes, liars figure, but figures don't lie. So how are you going to cut 2 trillion when there's only a trillion and a half of discretionary spending? And God forbid, keep your hands off my Social Security and my Medicare and the interest we have to pay and the debt and defense. He wants to increase that. So the numbers made 0 sense from the beginning. And I called that on November 6th, day after Trump won. And so they go along, and then it's okay. Now it's a trillion and a half trillion. Then they put this bogus stuff up on their website. If you look, and now Musk has left Doge. If you look at the details, I haven't looked in a week or two. But last I looked, it was 150 billion, 170 billion, some number like that. Keep in mind, our deficit is getting on, 2 trillion. It was 150 billion. But that wasn't even an annual. That was like total cuts over the life of the contract. So let's just do a little thought experiment. If you said it was 150 billion ratably spread over 5 years, it's 30 billion a year. On a budget which is 7 trillion. Julia, what was the question again? I mean, no, I'm teasing you, okay? It's just insane. It's a narrative.
That's probably an important part too, like the narratives that are out there as well. Interesting. I am looking at the debt clock right now. 36.9 trillion, as you point out, like the U.S. federal spending north of 7 trillion, the budget deficit just north of 2 trillion. The Doge clock on their site, it might be a little higher than the other numbers. I don't know.
What does it say? No, what does it say now? What does it say now?
This is the Doge clock on the U.S. debt clock. It's 486.5 billion. Am I reading that right? I don't know if I'm reading that right, y'all. Wait, billion. Wait, billion. No, it is billion. Sorry. It is.
Yeah, Julia, you're probably right. But again, I would say to you,
I don't know.
One, if you look at the history of all these alleged cuts, heretofore, they've all been debunked one by one. That's one thing. 2, even if it's spread over 5 years, okay, I'm just throwing that out. It's not 486 billion a year. It's over the life of those contracts, some of which go pay, right? So if you assume 5 years, it's still 100 billion. Mm-hmm. It's something in the right direction, but I'm willing to wager by the time it's all said and done, it won't even be half that amount. Even if I allow, 100 billion, it's not going to be half that amount. It's just relative to the 2 trillion deficit we have. And the fact that spending, I think, is running, you might want to look it up. I think spending is running up 7% year on year as I speak. in this fiscal year, which started in November, the numbers don't add up.
Will the spending keep the party going, as you put it earlier?
Well, until Mr. Bond shows up at the doorstep. So
that's the indicator to look at, is what's happening.
Yeah, let me put it this way. Let me put it this way. People say, well, what about the dollar? I think the dollar will go down, but what's even more interesting is I think most all paper money, most all fiat currency is going down, because we're not the only ones doing this, running these big deficits. We do it bigger and better than anybody else, which is why we have U.S. exceptionalism. But you're seeing fiscal expansion around the world now. I mean, I don't have to tell you. You spoke about it yourself. And look what's happening to Japanese bond yields. You've seen the JGBs yields levels not seen in decades. They've got an inflation problem. They're spending like crazy. Their debt to GDP is much higher than ours. So everyone's doing it. So I think the real message, and I want to get to what are people supposed to do with their money? Because I think you and I could go on forever on this macro stuff, but they're very rich topics.
Yeah, they're going to want to know what's the so what?
What's the deal? I think you've got to preserve your capital. In other words, get out of paper money. So I know it's boring, but gold, in broadly speaking, and you want to play gold mines, whatever. But gold, scarce assets, that's where you got to be. Some people want to own Bitcoin. That's fine. But things that the Fed cannot print more of and just create out of thin air, you want to own scarce assets. And so I point out to you that gold is going up against all currencies. You want to get into an argument, the euro is worse than the US is worse than the euro. Fine. But they're all going down against gold. Okay. I can't think of a single fiat currency that's gone up against gold, the major currency. So gold, for those that want to own Bitcoin, that's fine.
Do you own any, George? Do you own some Bitcoin?
No, but we're going to have an event coming up soon. My co-host of my Twitter Spaces, it's going to be like George burned at the cross in the public square. They've been working on me. I think the term is I'm going to get orange pilled or something like that. So,
okay, yeah, orange pilled. Okay, but
so you know what? So what's going to happen? I'll be able to go around now, buy like a fraction of a coin. I'll say, "Oh, I own Bitcoin now." So now they can't throw tomatoes at me anymore. So anyway, so I think you want to own gold. Get out of dollar cash. I think U.S. equities, Julia. Think about the S&P. It's denominated in American pesos. Okay, what do I mean by that? If we took the S&P and measured it in Turkish lira or some currency that's going to zero, all right, the chart would look even better. Okay, and so therefore, what I'm arguing is, gold. Even last year, when you had this S&P up 27% or whatever it was, 25%, gold was up as much as the S&P. And so, if I say to you, Julia, would you rather own gold or the S&P? You look back the last 5-6 years, gold has destroyed the S&P, even though we have this bull market going on in the S&P. So I would I know, humble, me talking so energetically, I would suggest for your consideration that when you look at the S&P, it's really one suffering from money illusion. If I put it into Turkish lira, it's gone up a zillionfold. If I put it into Swiss francs or Japanese yen, it's in a bear market. And you may say, well, George, what's the point of that? The point of that is, if I'm a European institution, if I'm the Swiss National Bank, don't ask me how they wind up with so much in equities. But at any rate, the last umpteen years, they benefited not just from the U.S. market going up, but the U.S. dollar going up against the Swiss franc. And ditto, if you're a Japanese investor, they've benefited not just from the U.S. going up, but the U.S. dollar going up against the yen. Now, U.S. markets let's forget about the U.S. market going down. Let's say the U.S. market goes sideways. If the dollar goes down 10 or 15%, and you own the S&P, let's not get creative here, you just lost 10 or 15%. And by the way, I note for the record today, before we just came on, supposedly, at least for now, the market's happy because we're not going to get any tariffs or whatever because of this court thing. Julia, take a look at the dollar today. It's going down, despite the fact we're not going to have these tariffs. What's with that? Okay.
And gold is up today. It's up $19. Yeah.
Hello. So the market's, because think about it, Julia. You're a foreign investor. Okay. You're in Zurich. You're in Tokyo, whatever. And you say, oh, okay, don't worry. Sanity's prevailing in the U.S. market. We're not going to have these tariffs, blah, 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 blah. It's all good, Julia. It's all good. And I'm like, wait a second. These guys change their mind every other day. And okay, maybe today it's all good, but what's it going to be like next week? Or if the court decision a year from now? Not only that, they're now talking about maybe, taxes on, the interest tax for foreigners and other stuff. I mean, there's so much uncertainty. And oh, God forbid, even if I think the dollar's not going to go, don't worry, we really like the U.S. bond market. The yields are very competitive here, and it looks really good. Their fiscal situation's in order. No, I don't think so. So again, I don't see how, to me, we're making the U.S. a very unattractive place. I mean, to hold U.S. financial assets, there are much better things to do with your money. So I go back to the word I used earlier, that rotation. It's not that U.S. market has to go down in dollars, but I think certainly, there are a lot better things you can do with your money. Buy gold, buy some foreign markets. I think the Japanese yen looks really interesting. It's very cheap. Go to Japan. It's like, hey, you travel someplace, you're like, oh, the dollar's strong, Europe is cheap, or whatever. You go someplace, the yen is absurdly cheap. And I think within the equity market, you also have to be careful about what you own. If you are going to own U.S. stocks, I think U.S. consumer stocks are dead, or as they said in Animal House, dead, dead, dead. I think real incomes, Niedermeyer, dead. They're going to, because real incomes, we know this, are being squeezed. Cost of everything's going up. Discretionary spending's under pressure. So I'd avoid consumer stocks. Healthcare selectively looks interesting, but it's a real landmine. I think there'll be a lot of opportunities coming out of there, but you got to be careful. I'd run, not walk, as fast away from Pfizer as I possibly could, because that to me is a black box, as is United Healthcare. And by the way, none of this is financial advice. So I just think if you look at it from a bottom up basis, because we've been talking all top down here, get away from the Mag 7. It's an electric car company, it shall not be named, which I think is probably epitomizes everything that's wrong with the U.S. stock market, but we won't talk about that company. But you look at the S&P 493, get away from Mag 7. Earnings aren't so great. Valuations aren't so great. It's like not a lot to like. So I'm sorry to be the sourpuss here, but I think the risk reward on U.S. equities looks decidedly unattractive, a lot more downside potential than upside. I wouldn't advise people to short it necessarily. Been there, done that. It doesn't always work. But I just think that if you want to be in equities, there are a lot better places to put your money.
So it makes me wonder too, we've had this whole passive investing movement. Everyone's buying the index, kind of own the same names. Would love to get your thoughts there on passive investing and how that plays out. But how about, does it kind of just get us back to you got to pick your spots? You need to be getting back to more of a stock picker's market, if you will.
Yeah. And I was always trained at Fidelity to be a stock picker. And at the end of the day, it's a market of stocks. I mean, you and I can spitball as much as we want about the big picture, but if we have a lot of good individual ideas, whatever. The S&P is an actively managed index. Money gets invested based on market cap. So money is invested based on the average return of capital, not on the marginal return of capital. So resulting in a huge misallocation of capital. If you gave me money to manage and I'm an active manager, and I said, Julie, you know what? I'm going to put 6% into Apple, whatever the weighting is. Why would you do that when there's been no earnings growth in Apple for 6 years and it's on 30 times earnings? I don't think you would. Or I put money into Tesla because I'm not sure what, I think it's 2% of the S&P or some number like that. So wait a second. This is a company that has an over $1 trillion market cap on 10 times falling revenues and increasing competition. George, why did you put 2% of my money into Tesla? That didn't seem like a very good idea. Oh, but we reduced your risk. Yeah, we reduced your risk. Risk is defined as the tracking error versus the index. But we actually took a lot of risk because that's not an attractive security. So I think it was Warren Buffett who once said, what the wise man does in the beginning, the fool does in the end. Indexation at the outset was a good idea. John Bogle, may he rest in peace. Please call your office. But now, no, I would get as far away from the S&P 500 as possible.
Real quick on gold, just as a quick follow up, because I take it even at these levels, you see room for gold to run. Because I'll tell you a quick story on gold. I won some money in college, with the entrepreneurship thing. I've told this audience this. I took that money in 2011, like August, September 2011. I put it all in gold, but I didn't do anything with it, and I kind of forgot about it. And I recently opened my statement, and I opened the statement yesterday. And I was like, okay, like I've come back. I didn't do anything with it, but I take it you see room to run here on gold, obviously.
Yeah, so Julia, don't open your mail again. Just leave it alone. Okay. Here's the problem. No, I love that. I love that story. Because here's the issue. How'd you open your statements? I go back to when people talk about, you got to be a long-term investor. Okay. So with my gray hair, okay, I lived through 87. I lived through the dot-com bust. I was there for the great financial crisis. Been there, done that, right? Amazon, roughly speaking, it went down 91%. Okay. It's like it went from, 100 to 9 before going up 50-fold. All right. Honestly, for those who opened their statements while it was happening, I think a lot of people would have been inclined to like hit the sell button, just get me out. I can't take this anymore. All right. But for those of you that forgot to open the statement, it's all good. All right. So gold, though, I actually think, this is going to sound crazy, but there was a wonderful contrarian investor at Fidelity, Leo Dorsky. He just passed away recently. And he was a big student of contrarian investing. In contrarian investing, it's not necessarily meant to be a wise guy thing. You say one thing, I say the opposite. No. You try to look for the variant perception. And what do you believe that the market doesn't believe? And let me give you an example. Let's say we have La Roche Pharmaceutical. And
no relation, by the way.
No relation. It's not financial advice. We have La Roche Pharmaceutical, okay? And they got this great product portfolio, and the stock's doing great, and the CEO is a great promoter, and, whatever. She's got her way about her. And people they make an announcement for, I don't know, some drug. The stock goes up. And someone says, you just own La Roche Pharmaceutical because you're a momentum player. It's got good relative strength. The earnings are going up. It's like, where's the contrarian view on that? And Leo would say, what you don't understand is that latest drug that they announced, it has applications that no one's really focusing on right now. Everyone's focusing on the cancer cure. But there's all these other things it can do. And the addressable market is far greater than people know. In other words, people are not bullish enough on La Roche Pharmaceutical. So take this, and he would say this about oil, go back 30, 40 years ago. You could be bullish on oil because the chart looks good and there's this narrative and that narrative. But maybe you do your work and you realize, you know what? Depletion's really high in the oil fields, and the oil price, if these numbers hold, can go up a lot more than people imagine. So what I'm telling you is to come back to gold, to the question, people aren't bullish enough. I said to you before that one of the big risks for equities is they'll be surprised by the speed by which and extent to which bond yields rise. I don't want to get in the hyperbolic mode, but I think gold has surprised most everyone how much it's gone up, and I think it will continue to do so. Julia, if you tell me what would cause me to change my opinion, if you give me a world where deficits are being brought under control, where interest rates are at a level where they're deemed to not be stimulative, where there's some fiscal sanity, is restored to the world, then I'll reconsider what I just told you. But as they say, gold is an asset. It's got unique qualities. It's an asset which isn't somebody else's liability. It's a scarce asset. It's held at store value over thousands of years. And, it's an insurance policy against stupid policies from politicians and central banksters, as they say.
Yeah. I'm going to sneak in one more question. You and I were talking before we started recording, and we were talking about the decision to close your ETF. And I thought it would be helpful to bring it up too, because I think there's some valuable lessons in there. Could you take us back to that time in choosing to close the ETF, lessons that you took away? Because as you kind of pointed out, you were a bit of the Pied Piper of the bearish group back then. Would love to go back to that time.
Thank you for that question. And I'm glad to answer that question. I think it's very important. We always learn more in failure than in triumph. And boy, did I fail. And one has to be careful not to climb into an echo chamber, which unknowingly I did. But I don't choose to define my career of 44 years by that unfortunate incident. There was a time, as I think you mentioned at the outset, I once ran the number one mutual fund in the country, and I've had a couple of successful hedge funds, and so this was a bad time in my life. And I got bearish into 21, beginning of 22, end of 21, and I discovered Twitter Spaces, now known as X. And I developed quite a following because I was giving the counter narrative to what you would see in the mainstream media. I was speaking, I guess people saying they're coming for the truth. Well, actually, what I was also doing is delivering content to people from a lot of the leading best minds in the research business. In any event, long story short, I started an ETF because people asked for it. And of course, in the 5-6 months from the time I decided to do it, which was the spring of 22, until it launched, which was September of 22, the market went down quite a bit. And as they say, timing is everything. And we started the ETF within, I think, a month or two of the bottom. And initially it went okay, and then not so much. And it was a real learning experience because I was short and I was wrong. And I think it was this is the Mark Twain line, Julia. It's not what you don't know which will hurt you, but it's what you think you know that ain't true. Okay. And so I was very sure of what I was thinking at the time. And I guess I look back on the instant replay, video replay, and I didn't see the extent of the monetary stimulus that was going to come to push asset prices up. And that's also been one feature about this market. You didn't ask the question, but I'll answer it. How are markets different now than they were starting in the 80s? Markets used to be discounting mechanisms. Markets would discount in advance. Stan Druckermiller would always say, the internals of the stock market are the best economist out there. But what's happened in recent years, asset prices have become such a tool of policymakers by which to influence the economy that they've ceased to become discounting mechanisms, and they're really more coincident indicators. Because think about it. If the stock market tanks, think what's going to happen to consumption. Julian, you know the numbers better than I. We've got a K-shaped economy. You have, 10% of the population accounting for some disproportionate part of the consumption, like 50% or something like that. I promise you, if the markets go down and housing prices fall, we will have a recession. All right. So trying to ensure that asset values stay high, it's become a matter of economic policy as much as anything else. And so markets have really changed. As I said, they've become coincident indicators, not discounting mechanisms. Also, going back to what you asked me earlier, Julia, we didn't have the passive thing the way we have it now. So then at the end of the day, it's the same objective, which is buy low and sell high. In a momentum market, as I like to joke, no, it's buy high and sell higher. But, the markets have really changed. And as the pool drains out from active management more into passive, this is creating more opportunities for active managers because individual securities are not as intensively analyzed as they once were.
Yeah. George, I have to say, I've really enjoyed having you on the show, and I feel like there are so many lessons along the way, and I could listen to you for a lot longer than this. But before I let you go, I want you to leave this audience with some parting thoughts, and I want you to let them know where they can support more of your work, find more of your work. You have these amazing X spaces, but you also have a conference coming up in next week, right? So let folks know about the conference as well. We can also leave a link for them in the show notes, but the floor is all yours.
Thanks, Julia. This has been terrific. I thoroughly enjoyed this. I could talk forever. I'm reliably informed that I talk too much, but
it's great. We don't have rules on this show. You can talk as long as you want. So
I know. Okay. So I'm on X, gnoble79. I'm on Substack, a little bit on YouTube. That's all evolving. I do spaces 4 days a week. We bring in people come not for me. I have really good speakers on there. And Julia, you're going to be on my show. You just don't know it. We're having this conference come up next Friday, June 5. It's undoubtedly going to be the best independent research conference ever held. I can say that without hesitation. In my humble opinion, it may be the best investment conference ever held. And that sounds like a pretty arrogant statement to make. And the reason I say that is, as opposed to most conferences you go to, where say it's hosted by a major Wall Street firm and they have their own analysts, this is literally an all-star team of speakers, the best independent research minds out there, Julia, many of whom have been on your show. So starting with Jay Pulaski, formerly of Morgan Stanley, going to speak on the tripolar world and capital flows. Ian Harnett from Absolute Strategy Research, the foremost European strategy firm. Stavros Treaties, Investmo Global. He has a technical service where he tries to identify the best opportunities globally. Tavi Costa, I don't know if he's been on your show, Julia, but you got to get him on. He's a great macro thinker. I think one of his precious metals funds is up 88% this year. So he's going to talk about gold and scarce commodities. Another guest you have to have, Julia, is Jordi Visser, formerly of 22V. Sorry, he's with 22V now, which is a sell side firm. He was a CIO of Weiss Associates, a major multi-strat firm until last year. I think they closed down. He's going to speak about AI and Bitcoin. But what's really unique about Jordi, he comes from a traditional market background. So he's one of the few guys that has the credibility to speak both about traditional, or they call it Julia TradeFi, I think, TradeFi as well as Bitcoin and crypto. Michael Howe, who I know you've had on, Julia, brilliant liquidity. The senior analyst, energy analyst on the street, Mike Rothman, he's been doing this since the 70s, used to be at Merrill Lynch. Another former guest of yours, we both love her, will vie for who can be chairman of the Melody Wright Fan Club, talk about housing. Louis Gav of GavCal, talk about global capital markets, in particular focus on Asia. John Roque, one of the best chartists out there, 22V. And finally, the well-known short seller, Mark Cahodes. So I'm blown away. I mean, because I get to listen to all these guys, but there's never been a conference like this, and hopefully it'll be the first of many. So that's next June 5. You can find it online.
I love it. And like I said, we'll leave a link for folks because, as you mentioned, some of these names have been on our show and they're certainly friends of this program. And we hope that you become a friend of this show because I have to say, I've had so much fun just talking to you, listening to you, learning from you. George Noble, CIO of Noble Capital Advisors, thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us learn and get better. And I look forward to having you on again soon. And best of luck with the conference. I'm sure it's going to be incredible. Really appreciate you taking the time today, George.
Thanks, Joe. I really enjoyed myself, and I'll keep watching. Take care.
Wonderful. Thank you.